Two New Yorks are moving at the same time in opposite directions. On one side, a seller's market with merely 11,000 buyers chasing just over 7,300 homes. On the other, city neighborhoods where inventory is up by double digits, even close to half. Here's the setup. At the end of 2025, Long Island ranked as the strongest place in the country to sell a home. December marked the third consecutive month it held that crown. The measurement is simple. When buyers outnumber sellers by more than 10%, you have a seller's market. On Long Island, the gap wasn't just 10%. It was 33.4% fewer sellers than buyers. Nearly 11,000 buyers were active across the Nassau County metro area, defined as both Nassau and Suffolk counties, competing for the homes of just over 7,300 sellers. Fewer listings, more bids, faster decisions. Now lift your eyes across the bridges. Citywide, the number of homes for sale rose by more than 9% year over year. And in certain pockets, the surge has been explosive. Brighton Beach posted the largest jump in available homes anywhere in New York City, with inventory up nearly 49% in a single year. In Queens, Flushing followed close behind at 48%. Rego Park and Long Island City climbed as well. Brooklyn's waves stretched across Bushwick, Crown Heights, Midwood, East Flatbush, and Sheepshead Bay. Even in Manhattan, the financial district stood out with one of the strongest gains in new listings. So what happened? First, timing. Mortgage rates stabilized late last year. Buyers drifted back into the market, and sellers noticed. More homes went into contract in December than usual for the season, and then new listings followed. That created a rare condition for New York, inventory rising even as sales picked up. The long-term shortage remains, especially in Manhattan, but for the spring hunt, the tone shifted. More doors to open, more chances to negotiate. The sprint became a jog. Now rewind a beat to the other side of the East River. Long Island's story is not abundance, it's scarcity. Low inventory meets determined demand. The result is competition that is fierce but focused. A North Shore advisor described Nassau County as immensely popular, less frenzied than 2021, but still marked by very low inventory. The most active segments are concentrated between $2 and $4 million in villages like Roslyn Heights, Old Westbury, and Brookville. Add top-tier schools and easy access to New York City, and you have the recipe for sustained bidding power. Valuations have been climbing, a boon for sellers, even as homeowners face the burden of higher property taxes tied to those increases. Put that contrast against a national backdrop. In December, across the country, there were 47% more home sellers than buyers, one of the lowest buyer levels on record, second only to the early pandemic lull. The strongest buyer markets clustered in the Sun Belt. In Austin, Texas, the balance flipped hard, an estimated 128% more sellers than buyers. That's a world away from Nassau and Suffolk. The divergence underscores this moment. New York's metro is breaking the national pattern. Long Island is a scarcity-driven seller's arena. New York City is becoming a market of options. Underneath these shifts runs the thread of affordability. Across the United States, home values were largely flat through 2025. Looking to 2026, economists expect national home values to grow by about 1.2%, a modest lift supported by gradually improving affordability and steady buyer demand. Mortgage rates are expected to hold above 6% next year. That is not the ultra-low floor of the pandemic era. But gradual rate moderation this year has already pushed affordability to a 3-year best, nudging more buyers back into the ring and giving both sides a little more breathing room. Sales should start to respond. In 2026, existing home sales are forecast to reach 4.26 million, a 4.3% increase over this year's projected total. Years of limited inventory and higher rates created a pent-up desire to move. If affordability continues to inch forward, a portion of that demand should finally break loose. The fall season already hinted at what's possible when mortgage costs ease and options expand. But construction won't be the hero next year. Single-family home starts are trending 5% below last year's pace as of August. If they fall a further 2% in 2026, Starts would dip below the roughly 947,000 homes begun in 2023, the current low water mark since the pandemic began. Builders are expected to rely on incentives such as rate buydowns to keep inventory moving. The pipeline is there, new homes built and still being finished, but the appetite to start fresh projects is fading into the slowest year since 2019. That macro path filters straight into New York's neighborhoods. In places like Brighton Beach and Flushing, a near 50% leap in listings shifts the conversation. For buyers, it means fewer panic offers and, in some cases, room to negotiate on price or terms. For sellers, it raises the stakes to price realistically and move quickly, because the gap between best in class and sits for weeks widens when buyers have choices. In the financial district, a strong gain in new listings also loosens the decades-old grip of scarcity, particularly for those angling for amenities and location without a bidding war attached to every open house. Meanwhile, Long Island's math still favors sellers. The definition of a seller's market, a buyer count that exceeds seller count by more than 10%, sounds modest until you see the spread. In December, it wasn't a 10% advantage. It was a 33.4% gap, nearly 11,000 buyers, just over 7,300 sellers. That imbalance supports higher asking prices and tighter negotiation windows, particularly in that $2 to $4 million band on the North Shore, where school districts, acreage, and commute calculus push top listings into multiple offer territory. Step into an on-the-ground moment. A homeowner in Old Westbury lists at $3.20 million. In this segment, buyers come ready. Pre-approvals in hand. Inspectors on speed dial. With the seller's market 3 months running, the playbook tightens. Move fast. Expect competition. Across the island, the same physics apply at different price points. Scarcity at $800,000 can feel as urgent as scarcity at $3 million when the buyer pool overwhelms the number of doors for sale. Back in the city, a different rhythm. In Brighton Beach, inventory up nearly 49% in a year means buyers who were edged out in 2022 and 2023 can re-enter the conversation. Flushing's 48% jump cracks open a neighborhood that has traditionally been a fortress of competitive bids. In Rego Park and Long Island City, a climb in listings opens lanes for first-time and move-up buyers who were once stuck window shopping. In Bushwick, Crown Heights, Midwood, East Flatbush, and Sheepshead Bay, the inventory spike stretches across very different corners of Brooklyn, creating micro-markets where price discovery is finally possible without the crush of a dozen offers on day one. This is also a rental story. Across the United States, rent affordability improved as incomes grew faster than rents in 37 of the 50 largest markets. As of October, a median income household would spend 27.2% of income on the typical U.S. Rent, the lowest share since August 2021. Looking ahead to 2026, multifamily rents are expected to rise just 0.3%, giving incomes a chance to keep catching up. Single-family rents, by contrast, are projected to climb 2.3% as many would-be buyers delay purchases and seek more space. But New York City is the exception to the easing. Local rent growth is expected to accelerate next year, bucking the national trend and reinforcing the city's gravitational pull and its pressure. The shape of demand is changing too. For a growing share of Americans, renting is not a stopgap, it's a choice. Nearly 3 in 5 renters say they plan to keep renting next year. Even if mortgage rates fell, only 37% say they would buy, down from 45% last year. Families are part of the shift. 37% of renters now have a child younger than 18 at home, up from 33% a year ago. With that comes a new set of preferences. Family-friendly amenities move from nice to have to must have. In New York City, communal spaces are poised to become defining features of the rental landscape in 2026 and beyond. Buildings that offer imagination centers, homework pods, and efficient layouts speak directly to the share of apartment shoppers making decisions with school schedules and stroller storage in mind. Transactions themselves are evolving. In New York's rental and sales market, technology is pushing the edges of what an efficient transaction can look like. A homegrown example: a real estate platform founded in 2018 that grew into an 8-figure business focused on New York rentals. The company has scaled to 75 full-time employees in the United States and 220 globally, and it recently closed $27 million in Series B funding to expand its reach. Its head of AI talks about systems thinking and using artificial intelligence to move from advice to action, aligning with a broader shift expected in 2026, when AI is set to evolve from helpful assistant to transaction coordinator. Instead of just recommending steps, AI could coordinate them end to end, from connecting buyers and sellers with the right agent to tour scheduling, negotiations, and closing prep. Fewer gaps, fewer surprises, a more predictable path from search to signed. Zoom back again to the macro forces. The U.S. base case of 1.2% home value growth and rates above 6% outlines a slow, steady grind higher. The forecast of 4.26 million existing home sales, up 4.3% from this year's projection, suggests some pent-up moves finally hitting the tape. New construction restraint, the 5% slowdown in single-family starts as of August, and the potential 2% further drop toward a level below 947,000 means the inventory relief arriving in New York is unlikely to be, reinforced by a wave of brand-new houses. That puts even more emphasis on existing homes, pricing power, and negotiation strategy. Within that frame, Long Island's scarcity is likely to persist through the near term. A 3-month streak as the top sellers market sets expectations, and the numbers back it up. A 33.4% shortfall of sellers relative to buyers, translating into nearly 11,000 hunters against just over 7,000. 300 listings. Where there is breathing room, it tends to occur at the margins, properties that are mispriced, mismarketed, or lingering outside the prime school corridors. For most midtown commuters scanning listings in Roslyn Heights or Brookville, the message is the same. Be prepared, be decisive, and expect competition, especially between $2 and $4 million. For New York City, the watchword is choice. A citywide gain of more than 9% in homes for sale reshapes the buyer experience. Brighton Beach's nearly 49% jump in inventory turns a thin, competitive market into one where buyers can compare layouts and views instead of only reacting to what's available. Flushing's 48% surge opens doors that were effectively locked last year. Rego Park and Long Island City's climbs hint at broader Queens momentum. Bushwick to Sheepshead Bay in Brooklyn and the Financial District in Manhattan. Each shows the same pattern. New listings arriving even as contracts pick up, the rare double motion that allows pressure to ease without the market stalling. If you're a seller in these neighborhoods, the lesson is clarity. Price to the market, not to a memory. If you're a buyer, the lesson is patience with purpose. Inventory spikes don't last forever, but they do change the tempo. Stand ready with your financing, and take the extra day to compare the lineups while you have them. There's also a deeper resilience at play. Global cities have faced shocks before and found their footing. In the wake of past crises, transaction volumes dipped, sentiment wavered, and capital values took temporary hits, often falling by single digits in stable markets, before activity returned to normal within 1 to 2 quarters once uncertainty cleared. New York learned this the hard way and rebuilt. The lesson is not to minimize risk. It's to recognize the muscle memory of a market that recalibrates rather than collapses. That context matters for renters as well as owners. With rent affordability improving nationally, 27.2% of income for a median income household as of October, most big markets are moving slowly toward balance. But New York's expected acceleration in rent growth sends a clear signal. Families, students, and mid-career renters will continue to drive demand for well-located, amenity-rich buildings. With nearly 3 in 5 renters planning to keep renting next year, and only 37% saying they would buy even if rates fell down from 45% a year earlier, the rental market's backbone is strengthening. Buildings that invest in communal spaces and family-friendly design will meet the moment and likely win out. For investors and developers, the construction outlook is a caution flag. A 5% year-over-year slowdown in single-family starts as of August, paired with a potential 2% further drop in 2026, anchors expectations below the 947,000 homes begun in 2023. That's the slowest cadence since before the pandemic. Incentives like rate buydowns will help absorb current inventory, but the spigot for new product is tightening. In New York, where buildable land is scarce and timelines stretch, this macro backdrop reinforces what the listings already show. The existing stock will carry the load. Let's connect these threads into a causal chain. What happened? Mortgage rates stabilized late last year, nudging both buyers and sellers back into action. Citywide inventory rose by more than 9% year over year. In neighborhoods like Brighton Beach and Flushing, the surge reached nearly 49% and 48%, respectively. On Long Island, listings stayed tight, resulting in 33.4% fewer sellers than buyers, nearly 11,000 hunters against just over 7,000. 300 homes in December, locking in a third straight month as the country's strongest sellers market. Why did it happen? Stabilizing rates improved affordability enough to thaw a frozen market. Years of constrained supply collided with pent-up demand, and then the psychology flipped. Buyers stepped forward, sellers stepped out of the shadows. And a rare condition emerged, where more homes entered contract in December than the season typically allows, while new listings also piled in. Outside the city, in Nassau and Suffolk, demand stayed deeper than supply, especially in that $2 to $4 million range in villages like Roslyn, Roslyn Heights, Old Westbury, and Brookville, where the calculus of schools and commute is non-negotiable. Who is affected? In the city, first-time buyers and move-up families benefit from choice. In the boroughs with the biggest jumps, Brighton Beach's nearly 49% and Flushing's 48%, long shut doors are opening. In Bushwick, Crown Heights, Midwood, East Flatbush, Sheepshead Bay, and the Financial District, the shift from scarcity to selection gives shoppers a say. On Long Island, owners gain leverage and buyers face a clock. Competition tightens in a market with 33.4% fewer sellers than buyers, and the bidding edge in December stretched across nearly 11,000 active buyers. For renters citywide, the expected acceleration in rent growth keeps pressure on budgets, even as national rent burdens ease to 27.2% of income. Families make up a growing share of that demand. 37% of renters now have a child under 18, up from 33%, reshaping what buildings need to offer. What's next? The U.S. outlook for 2026 calls for home values to rise about 1.2%, mortgage rates to hold above 6%, and existing home sales to reach 4.26 million, up 4.3% from this year's projection. Builders are likely to start even fewer single-family homes, with starts already 5% below last year's pace as of August, and a potential 2% drop ahead, below 947,000, so don't expect new supply to bail anyone out. Multifamily rents should rise just 0.3% next year, while single-family rents climb 2.3%. New York City is the exception. Rent growth is expected to accelerate, and communal spaces will become defining features of the rental landscape as nearly 3 in 5 renters choose to stay renters. On Long Island, expect the seller's advantage to persist into the new year, especially in the North Shore segment between $2 and $4 million. The December gap, 33.4% fewer sellers than buyers, won't unwind overnight. If mortgage costs continue to ease within that above 6% band, more buyers will step forward, but in a tight market that only intensifies competition unless listings rise. In the city, expect the neighborhoods with the biggest inventory spikes to set the tone for spring and summer. Brighton Beach's nearly 49% surge and Flushing's 48% jump provide enough supply to stabilize prices and lengthen decision windows without flipping the market into a glut. Rego Park, Long Island City, Bushwick, Crown Heights, Midwood, East Flatbush, Sheepshead Bay, and the Financial District form a web of opportunity where the best-priced homes will still move quickly, but buyers can compare instead of capitulate. And across both worlds, city and island, expect the transaction itself to feel different. A maturing layer of technology is moving the process from a juggling act to a guided sequence. One New York-focused company that began in 2018 scaled to 75 U.S. employees and 220 globally, and just raised $27 million to keep building. That kind of investment aligns with a broader shift in 2026, when AI evolves from helper to coordinator, stitching the search, scheduling negotiations, and prep into a cleaner line. In a market where timing matters, think Long Island's 3-month seller's streak or a Brighton Beach listing that finally has peers to measure against, that coordination is leverage. Here's the outlook, clear and crisp. Base case, in 2026, New York City maintains a buyer-friendlier tempo in neighborhoods where listings jumped. Citywide inventory stays materially higher than a year ago, while Long Island continues to operate as a strong seller's market, especially in that $2 and $4 male North Shore corridor. Nationally, modest price growth of about 1.2% pairs with rates above 6% and 4.26 million existing home sales, up 4.3% from this year's projection. Rent growth in New York City accelerates despite national easing, and communal spaces become new musts for buildings courting families, who now make up 37% of renters, up from 33%. Two watch items to track through the first half of 2026. First, the pace of new listings in the neighborhoods that saw the sharpest inventory spikes, if Brighton Beach is nearly 49%, and Flushing's 48% jumps, are followed by another wave of sellers this spring. Price stability will strengthen, and buyers will hold more negotiating power through summer. If new listings stall, the window narrows fast. Second, the path of mortgage rates relative to that 6% line. If rates hold modestly above 6%, the base case holds. If they dip materially, expect buyer activity to swell into Long Island's already tight market and pull some of the city's new listings off the shelf faster than expected, especially in Queens and South Brooklyn. New York is moving in two gears, the city opening up, the island tightening, and the numbers tell you where to look, how fast to move, and what to expect next. If you want more straight, data-anchored clarity on this market as it changes, keep watching.